All right, today we're diving into a real head-scratcher from the world of Japanese industry. We're talking about Nachi-Fujikoshi, a manufacturing giant whose recent financial performance has a lot of people talking, and for good reason. It just doesn't seem to add up.
So here's the central puzzle, the question that sparked this whole analysis. How on earth can a company's profits shoot up by almost 50% at the exact same time its sales are actually dropping? It feels like it defies the basic laws of business, right? Well, that's the paradox we're going to unravel today. And when you look at the numbers, they're not just a little off, they are stark. Revenue, as you can see, took a small dip, down about 1.7%, but at the same time, operating profit just rocketed upwards by a massive 47.3%. This is the mystery we're here to solve. So, here's how we're going to break it all down. We'll start with those puzzling numbers themselves. Then, we'll uncover the internal surgery that explains how they did it. We'll look at the company's big challenge, balancing its old cash cows with its new growth engines. We'll put it all in a global context, and finally, we'll weigh the bull versus the bear case to get to the one big takeaway. All right, let's get right into it. First up, that puzzling profit. We need to look closer at the actual numbers that cooked up this whole mystery in the first place. Okay, so check this out. Revenue down about 1.7% to $1.58 billion. You know, in a tough global economy, a small dip like that isn't a huge surprise. But look at the profits. Operating profit jumps over 47%, and net profit, that soared by almost 57%. I mean, this wasn't just a little bump. It was an absolute explosion in profitability. So the $65 million question is, how did they pull this off? Well, that brings us to section 2, the internal surgery. And the answer isn't some kind of magic. It was the result of a very deliberate, aggressive, and frankly, pretty clever internal strategy. The key phrase you're going to hear is structural reform. Now I know it sounds like some generic corporate buzzword, but for Nachi, this was the real deal. They went deep, cutting fixed costs by getting smarter with their equipment and personnel, and at the exact same time, they were able to pass on rising material costs to their customers through price hikes. It's a classic 1-2 punch to boost your margins, and they executed it flawlessly. Now, they also got a little bit of help from the outside, a nice tailwind, you could say. The Japanese yen was pretty weak in 2025, averaging around 149.5 to the US dollar. And since more than half their sales are overseas, a weak yen is great news. It means when they bring all that foreign profit back home, it translates into a whole lot more yen. It's a nice little bonus that definitely padded the final numbers. But even with cost-cutting and a weak yen, that still doesn't tell the whole story. No, the really fascinating part was this incredibly clever accounting move. Some analysts are calling it profit smoothing. It was a brilliant bit of financial engineering. Just look at how they balanced the books here. That big reform effort, it came with a hefty one-time cost, about $20.8 million. That's a big hit to your bottom line, right? But, and this is the genius part, in the very same year, they sold off some investments and booked a special one-time gain of almost the exact same amount. So what was the net effect on their final profit? Basically zero. They used a gain to perfectly cancel out the pain, protecting their net income from those costly but necessary reforms. Okay, so we've figured out the how on the accounting side, but what about the actual business itself? This is where things get really interesting. We're moving into engines versus cash cows, because this is the story of a company in the middle of a major transition, trying to pivot from its past to its future. A quick look at where the money's coming from tells you a lot. You can see that big slice of the pie, over 62%. That's their traditional components business. We're talking bearings, hydraulics, that sort of thing. The next biggest chunk at about 31% is machine tools, and that's where their robotics division lives. Just keep those two in mind. And this right here, this slide lays out Nachi's central dilemma. On one side, you've got their cash cow, the components division. Its profit went through the roof, up over 200% because of those reforms. But here's the problem. A lot of those parts are for gas-powered cars, and you know where that market's headed. Then on the other side, you've got their growth engine, machine tools and robotics. This is their future, where they have their highest profit margins. But sales actually fell last year, mostly because of a slowdown in China. So you see the conflict. Their past is super profitable right now, but at risk, while their future has huge potential, but is currently struggling. So what's the game plan? Well, Nachi is basically going all in on that growth engine. They're betting the entire future of the company on a big strategic pivot into high-tech robotics and specialized components designed specifically for the electric vehicle revolution. And believe me, this isn't just talk on a PowerPoint slide. They're rolling out some really game-changing stuff. Their MZS-05 collaborative robot, or cobot, has a world-first anti-collision function, which makes it way safer and faster for people to work right alongside it. They're making these high-value bearings specifically for EV motors that solve a huge problem called electrical corrosion, and their air skiving system is a super efficient new way to make critical gears for EVs. Each of these innovations is aimed squarely at a high-value problem in the future of manufacturing. Okay, so let's zoom out for a second and look at the global picture, because to really get a handle on Nachi's challenges, you have to know where the money is actually coming from. This chart shows that Nachi is a truly global player. The split is almost dead even, 50-50, but overseas sales at 50.8% have just nosed ahead of their home market in Japan. And this global exposure, well, it's both a major strength and a potential vulnerability. And when you dig into those overseas sales, one country really pops. China makes up over 15% of Nachi's total revenue. That makes it their single biggest, most crucial foreign market by far. And that is how we connect the dots. That slowdown we're seeing in China's industrial sector, it's the direct cause of that 5.3% sales drop in their super important high-potential robotics division. Nachi's future is tied to robotics, and right now, robotics is tied to the health of the Chinese economy. So, putting it all together, what does this actually mean if you're looking at this as an investment? Well, that brings us to the classic debate, the bull versus the bear case. Let's look at the arguments for optimism and the reasons for caution. Let's lay out the arguments. The bulls will tell you that this internal surgery is clearly working. It's boosting margins. They'll point to the very clear strategic pivot into high-growth areas like EVs and robotics, and they'll highlight their growing business in North America and their unique advantage of being vertically integrated. But the bears have some pretty strong counterpoints. They'll argue that this profit growth is way too dependent on a weak yen, that China's slowdown is a huge headwind for their crucial robotics growth engine, that they face brutal competition from giants like Fanuc and SKF, and that a low return on equity of just 3.2% shows they're just not using their capital very efficiently.
Which brings us to the bottom line, the final takeaway. After digging through the numbers, the strategy, and all the risks, what does it all really boil down to? You know, the entire story really comes down to this one single question, which the analysts at HDIN Research summed up perfectly. Nachi has this incredible, deep expertise in making the fundamental materials that go into machines. The ultimate question is whether they can translate that foundational strength into explosive, nonlinear growth in their robotics business. If they can pull that off, they'll break out of this transition and enter a true expansion phase. But if they can't, they risk getting stuck right where they are.
So, there you have it, the story of Nachi-Fujikoshi, a company at a fascinating and critical turning point. If you want to dive deeper into the full professional analysis and see all the data for yourself, you can find the entire report over at HDINResearch.com. Thanks for watching.